Good afternoon once again, and a warm welcome to all those who just joined us and our online guests as well. We are now going to begin our proceedings for the 2021 full-year analyst briefing. Before we do that, allow me to introduce our senior leadership that is taking us to the session. Firstly, we've got our Managing Director, Kiran Makshiri, and our Chief Finance Officer, Mr. Fano Kapange. So we'll start with the proceedings. I'll hand over to Fano.
Thanks, Right. Good afternoon, colleagues, and good afternoon to guests that are joining us online. I will take you through the financial part of the presentation. I think Kiran will come in a little later and deal with how we see things playing out in the future and discuss a little bit about our strategy as a business going forward. Now, just to discuss the financial performance, I think it's important just to lay out the context that we had to grapple with during the course of the year 2021. Colleagues will be aware that the beginning of the year there was quite a lot of optimism around the market about the performance of the economy. Notwithstanding the fact that at that time we still had COVID quite pronounced, but I think the prospects for the country were actually generally looking quite positive at that time. You will recall that in terms of growth projections for 2021, some attractive figures were being prepared to 7.8% at the time. I think a lot of that optimism would have carried forward to the second half of the year, which then speaks to the net outturn in terms of GDP growth for 2021. This optimism was anchored primarily on very good performance that was noted then in some of the sub-markets, particularly the agriculture sector, where we had a fairly good season for 2020 and 2021. And I think the focus growth then was actually at 34% for this current season. We saw a fairly good performance of the stock exchange, 135% year to date as of June, and capacity utilization industry was also looking quite good at 54% at the end of Q2 2021. And I think going forward to the second half, we saw that metric increasing to about 61%. Now, whilst there was that optimism, I think as the year progressed, we also then started experiencing at a macro level headwinds. And particularly, you will find that in the second half, we found inflation pressure beginning to surge upwards, having come down quite significantly in the first half of the year. And towards the end of the second half, we saw that beginning to creep up once again. And quite a bit of that would arguably be related to the movement that we saw happening on the current market. In fact, on the official market, we saw a faster rate of depreciation of the currency. It at 21%, which was quite high compared to the outcome that we saw in the first half of the year. And obviously, as that happened, there was also a widening of the gap between the official markets and the informal markets. But I did mention capacity utilization, performance of the external sector, quite tepid. I think the outturn, both imports and exports, was actually lower than the total outturn for the first half of the year, with only a 20% increase on first half numbers for exports and 89% for imports. Now, during that period, with all these headwinds and a mixture of optimism and pessimism in some of the markets, we, as a bank, obviously had to respond. And I think the biggest area that we then focused on was actually around maintaining and growing quality our balance sheet. And to do that, we ensured that in the first instance, we consolidated on our capacity to do business. And we were able, as a result, to meet the minimum capital requirements that came into effect at the end of December at the equivalent of $8 million United States dollars. And obviously, that figure in terms of regulatory tracking is reckoned in Zim dollars at the official exchange rate. We also looked to our group muscle to consolidate group synergies in the area of asset development and also mobilization of offshore funding. And part of that, we have seen us participating in a syndicated facility for ZTTPC, where our total participation as a group was actually at 10 million. Quite interesting days indeed, and I think we should actually be looking at a lot more being done in that space going forward. And we also played a part in activating performance in some of the growing sectors of the economy. And quite interestingly, the agriculture sector being one, where our participation is actually increased during the period from 12% to 16%. And just to give color to that story, our growth in the loans and advances increased by some 88%. The commercial loans, which is funding the product to the productive sector, would also increase by about 7%. But at the same time, we would also repeat government stock, treasury bills, and other similar instruments, and that would have been sitting at about 16% at the end of 2021. Now, in terms of just ensuring that we become sustainable as a corporation with all the fragility in the economy, we also then came into the market to introduce products and also just to enhance our value proposition to our clients. So we would have probably seen one of the country in respect of that also on that Zipit Smart, which some of us are beginning to use just invest billing just to facilitate great access to digital platforms. I think that's particularly to our retail customers across the country. And also to just assist with the movement of value at the retail level. We also introduced the rural tranche services offered across our network. And obviously, it's one of those markets that one day it's up, one day it's down, and to be affected quite significantly by developments that take place in the monetary system. We also introduced the network of functional ATMs that we run just to get customer convenience going, but also as a response to the COVID situation, just to minimize the flow of traffic into banking halls. And I think that was received quite favorably by our customers. And over and above that, we also looked at foreign currency business as one of the areas within which we planned and intended to grow. I'll speak to in a short while. That speaks also generally to the trends that we see on the market in terms of the concentration of business between foreign currency and local currency. So that gives a bit of background to the environment that we operate in and some of the high level risk coming from First Capital Bank. Now I'll turn to the financial performance for the full year. I think in this you will probably hear me talk about bank and group pretty much in the same vein. I think it's the same thing. You don't really need to read too much into that. The reason why when you then look at financial statements, we publish them as consolidated is because of an acquisition that happened during the year of a company that is otherwise dormant that owns a property, which is something that thought would strengthen our balance sheet. So I will use those two terms interchangeably. And in terms of the analysis itself, I'm going to be speaking to inflation-adjusted numbers. Those are our primary financial statements. In the press pack, you will see that we also include historical numbers for those that we want to have context in that kind of fashion. Having said that, the bank posted a profit, in fact, an increase in profitability during the course of 2021, 342% increase in profits after taxation. Our total income for the year was at 7.5 billion, which compares against 5.4 billion for 2020, and that's a 39% increase in value. Our total expenses also would have increased by some 35% from 3.2 in 2020 to 4.4 billion in 2021. Then we would have posted a net management loss of just about half a billion, pretty much the same level as we had in 2020, and that comes essentially from typically monetary balance sheet that we manage as a business. Now, I'll speak to that in a bit more detail later. We had a contribution coming from a joint venture enterprise in which the bank owns 50% at 1.5 billion compared to a loss of 163 million in 2020, and that's an outcome of just over 1,000%, a significant part of that is really attributed to the revaluation of underlying assets in that portfolio. That then leaves us with a profit before tax of 4 billion, increasing from 1.5 to 1.4 billion in 2020, and the profit after tax of 3.4 billion, increasing from 759 million in 2020. And obviously, with some of the hard portfolio we've got in terms of hard assets, when we then throw in the revaluation of those assets, which we treat as other comprehensive income, our total comprehensive income for the year comes in at 5.3 billion compared to 567 million in 2020, and that's an 32% increase. So that's the total growth in value that has actually come during the year from operations and also for the evaluation of some of the investments we have on portfolio. Just dealing a little bit with the revenue on a year-on-year basis, you will find that there is actually growth that happened in some of our core lines of business. If you look at the waterfall graph on the chart, fees and commissions have increased 712 million, interest income 1.2 billion, and our interest expense is actually come off 133 million, and obviously fair value credits are also contributing to that projection. That speaks obviously to an improving quality in terms of the sources of revenue that we are pushing, and also the business operations that we are running. We obviously see a reduction in trading and investment income, and a lot of that is attributed to exchange-related income. I'll speak to that in a little while. Now, going to perhaps unpack the composition of that revenue a little bit, you will find that we still have bigger concentration of our revenues sitting in local sources, $10 denominated sources, that is. But that's not to suggest lack of effort in mobilizing foreign denominated revenues. Obviously, there is a time lag that you would expect. And when you look at 2021 particularly, you then tend to find that as the year came to a close, we were actually experiencing an increase in the volume of business that we were pushing in foreign currency. So our foreign currency income contributes 2021 18%, and that being a reduction from 23% in 2020, whilst our local income contributes 71%, which is pretty much the sort of color that's shown for 2020. Now, just focusing on net interest income in a bit more detail here, you generally find that our interest earning rates have generally been below inflation, which closed at 60, I think just over 60%. So on an aggregated basis, our average yield during the year would have been somewhere in the region of about 35%. And of course, there are quite a number of reasons why we've not been able to push these earnings to a level that is much higher than this. One of the reasons is generally the liquidity gluts that characterized the market during the course of 2020 2021. The reason why NMCDs then became a big factor on the market. But also there is the issue of competitiveness. You generally find that outside other pricing models we refer to, we also then look to competition and try to be competitive in this space. And we see a subdued trend as far as that is concerned. Now, when you then look at the funding side, you generally see low cost of funding, largely because the funding base for us is generally been transient in nature. Demand deposits is it way, and on those demand deposits, you really get to pay a reasonably lower rate. But demand deposits of the character that we carry constrain you in growing the balance sheet, so to speak, because every now and again you've got to come back and fund the demands from the customers. So we are forced, as a result, to maintain a significant chunk of our deposits in non-interest earning instruments, and therefore are not capable of giving out to customers a significant return as each way. Now, when you look at non-funded income, which itself constitutes 64% of total income, down, of course, from 75% in 2020, you actually see a scenario in which the fees and commissions, which is really the core of the business, so to speak, in terms of the the transactions that customers do on our platform, those would have increased to by some 33% during the course of 2021. I must at this point add the fact that this is an area in which we found ourselves quite constrained. There is always the due from public and even regulators that the fees charged by banks are too high. So despite the cost pressure that we actually have to deal with on a daily basis, we don't have as much flexibility in adjusting these fees and commissions upwards. So what you are seeing here, making this increase, is a combination of an increase in the actual number of transactions on the platform, as well as mild fee adjustments that would have been effected during the course of the year. Interesting for us is the fact that digitally orchestrated commissions are actually making 34% of the total commissions that we book. And that speaks to one of the elements that is quite core of our strategies, which is really to digitalize the bank as much as possible, with the view that in doing so we lower cost of doing business, but also expand our reach as a business to a wider customer base. Looking at the other income sources, I did mention the fact that part of that reduction is a result of a drop in the FX related income, largely reflecting the movement that has taken place in the exchange rate during the period, which was not as aggressive as would have been the case in 2020. But that drop obviously would have been partially offset by the fair value gains to then ultimately result in only 4% rather increase in other income. Now, if I can just very quickly turn to the cost profile for 2021, you will see that between 2020 and 2021, a significant movement in our cost base would have happened on key lines like staff-related expenses and infrastructure related expenditure. We're operating with a fairly significant amount of pressure as far as cost expansion is concerned. But I think during the period, one of the things that we have then done is to try and build off the balance sheet and the earnings that we make, try and build capacity for the long term, the business capacity for us to be a bit more sustainable. And you will see that expressing in the form of the level of expenditure that is going into infrastructure costs. Part of this will actually obviously be IT related. Part of that also would have been related to the network that we run. But also you will see quite a significant chunk having gone to staff costs. And obviously it's about trying to maintain and even grow the capacity that we've got in that space for us to remain competitive as a business. Now, if I may just very quickly turn to the performance contribution by the business units that we run. You will note, colleagues, that we have profitability coming from all the segments in the bank, and I think that's a positive thing. That actually means that all the business segments are actually making a decent contribution. But also importantly, you also notice that we are pretty much a corporate-led operation in terms of the business model. And I think we're seeing a lot of movement in that area, and the story that we've seen for 2021 speaks to a growth profile as we go into 2022. And I think Kieran, when he covers the strategy and outlook, you will deal with that in a little bit more detail. Then just focusing on some of the key performance ratios that we manage. I think on an aggregate basis, they speak to prudent management of the business, as well as perhaps a profile that speaks to sustainability going into the future. But I will just refer to maybe one or two of the slides. You'll notice our cost to income ratio having come off a little bit from 60% to 58%. At the same time as that happens, you will see our non-performing loans being quite low at just 1.2%. A little bit of an expansion from last year, which speaks to the growth in the underlying assets themselves. In our operating jaws ratio, down to 4% from 51% in 2020. I think that really just speaks to the effect of cost momentum that built up during the course of 2020. We inflation was quite high, and some of those costs we have on the book only have been adjusted towards the end of 2020 and into 2021, narrowing the gap that you see having been created in 2020. And of course, when you find this, these jaws beginning to close, you then begin to worry about sustainability going forward. And for us, that then makes cost containment a key strategic issue as we go forward. Now, speaking to the statement of financial position, our total assets increased by some 30% from 23 billion to 30.3 billion. And out of that, you notice that interest-earning assets would have increased in real terms by 46%. A significant part of that being an increase in loan book, which came in at 88%. And that then speaks to the numbers that you saw earlier in terms of net interest outturn, as well as the NPL ratios that I referred to earlier. Then, as far as the funding side, you'll see some growth also coming through on customer liabilities at 16%, which is also quite positive. I think in our case, not only are we benefiting from the restatement of foreign denominated balances included in these numbers, there actually is growth that has been posted in terms of the underlying business count of relationships and stuff like that. Now, just focusing a little bit around the complexion of the assets. One of the things that we've tried doing in 2021 is to try and harden the balance sheet, and one of the we've done that by mobilizing foreign denominated assets as one initiative, and also mobilizing real estate is another initiative. During the course of 2021, I think we have posted some modest results in that space. Acquired one or two significant properties in our portfolio, but also we were able to push quite aggressively in terms of foreign currency denominated assets. Obviously, the pace is not yet at levels that we want them to be, but it's an area of effort as we go forward. Then looking at the interest earning assets growth, I think I've pretty much covered this in an earlier slide, but this was really just to demonstrate the specific areas where that growth would have happened. And again, just to emphasize, we see quite a significant contribution in that growth coming from the productive sectors of the economy in the form of the business banking contribution and the corporate investment banking contribution. Spin that around and look at the customer deposits. Not entirely an attractive story. We see the uplift in our customer deposits coming through from the demand deposits, and I think that speaks quite a lot to the saving culture in the country. And I think it's an area that requires a few matters at the macro level to be addressed before we can actually see a lot more saving coming through its other savings accounts. Just to show where the sectoral distribution is in terms of the loans and advances and the deposits portfolio, you will see quite a fair spread, meaning that we actually do not have, I would say, a serious risk of concentration, as it were. But I think that fair spread also speaks to the depth in our operations, and also perhaps gives a sense about sustainability of operations into the long term. And it's a profile that we are very comfortable with, and probably let's seek to sustain that situation going forward. Just to give you a sense, in terms of the capital position, I did mention earlier that we were able to meet the minimum capital requirements quite comfortably at 75 million equivalent in US dollars. Our core capital was actually at 8 billion Zimbabwean dollars. And those ratios you see speak to a very comfortable capital adequacy ratio, meaning that we've got quite some capacity to underwrite business expansion, at least in the foreseeable future, hopefully without having to ask for additional capital from shareholders. 30% Tier 1 ratio compares with the regulatory minimum of 8% in that space. That just speaks to the margin of safety that we've got there. And the total capital adequacy ratio, sitting at 37%, compares with the regulatory minimum of 12%. So we are quite comfortable in that space. But obviously, that doesn't mean that we then stop looking after the capital. I think capital preservation remains a fundamental issue, particularly if we can then mobilize that capital in the right form in terms of character, currency, and also in terms of nature generally. Liquidity ratio, we closed the year at 58%, but otherwise operated throughout the year above that kind of level. And that speaks to the ability to meet customer demands. And it also dovetails into the conversation that I made earlier, where I did indicate that because of the transient nature of our deposits, we are forced to then maintain significant liquid assets on portfolio just to deal with the customer transactions. Loans to deposits ratio at 44%, obviously also speaks to capacity for expansion going forward into the future. And we're seeing quite a lot of that coming through, particularly in foreign denominated balances. There's quite a lot of demand coming through there. Now, the performance that I've just indicated, and also the completion of the balance sheet that I've shared, the board deemed it prudent to pay a dividend. In fact, the first dividend was paid as an interim dividend at 108 after the half-year results were published, and a final dividend at 834 has been declared. That speaks to a dividend payout ratio of some 28%, with a comfortable cover of 3.56%. But we also see and feel that in an environment like we're operating in, there is a need to also give a reasonable return in terms of cash flow to some of our key stakeholders, so that they may also be able to deal with the challenges that are obtaining from the market, so to speak. So, ladies and gentlemen, I think I will leave it at this point. That is the performance of the group. The actual press pack, I think, will be available to all of you soon after this session, and this presentation is also going to be available. Let me leave it for Kieran to just lead a discussion around how we seek to progress going forward. Kieran?
Thank you, Tamo. Before I get into looking ahead, perhaps I'll just cover a couple of things to wrap up. It's been a very good year, the last year, not without its challenges, as Tamo noted. But there's kind of 6 points I just want to highlight before I move to looking ahead. First and foremost, we had good, solid balance sheet growth with a quality loan book, as you can see from the results, which translated into good P&L growth. Even allowing for inflation, even stripping out the property revaluations, we still managed to grow our P&L results. Our capital is strong. We achieved in September, as Sam said, the 30 billion, and we finished very strongly. We're paying a dividend back to all our stakeholders, which is important. And it's important to remember also that we're probably the only bank in Zimbabwe where our employees own 15%. So employees are going to share in that growth and that trajectory. And I guess on the back of that, it's really just to thank our staff, because it's been a huge effort over the last year. And these results are good, solid results. So we should certainly, I'd like to acknowledge all the efforts of our staff. Thank you very much. Plus our stakeholders. All of our stakeholders have been involved in this. So I think we should acknowledge those. So with that said, let's look forward. Our strategy going forward is really anchored around our core values. And they're around collaboration, integrity, innovation, service excellence, citizenship. And you can see a lot of that is anchored in here. Our business is really about growth. Growth for the business, growth for our partners, growth for our staff. So sustainable growth in terms of mobilization of quality funding. We don't get the liabilities coming in, either through our deposits, through third-party lines of credit, we won't achieve the growth we want to achieve. So that's a key area of focus for us. And it's about strategic partnerships that will be sustainable going forward, providing business solutions for us, for our customers, working in partnership. Customers are our core. Service excellence is one of our core values. And we want to be a trusted partner and advisor to our clients. That's something we value very strongly. That's something we try and push very hard. That if our customer has a problem, we try and come up with a solution that will work for them and work for us. And that also links to service excellence. It also links to innovation. How do we think about solving problems in a unique, innovative way? Tailored solutions, similar to that. We need to build out our platforms. We've done a great job in the last few years of, first of all, transitioning onto our new platforms as part of the First Capital Bank family. We stabilized those platforms. They are very stable and they're working very well at the moment. We've done a lot of development this year, and I'll talk in a few minutes about the development of our plans going forward. We need to optimize our infrastructure and processes. We want to be an efficient bank for our customers, for our staff, because that's how we're going to achieve growth. People is at the core of our business. Our chairman always says, and he's right, our business is really about people, technology, and process. People being core and fundamental to that. Control and compliance. We're a regulated entity. We take people's money, we lend it on, we have to make sure controls and compliance are at the core of everything we do. And that's important for our customers, important for our staff, important for our regulators. And I'm pleased to say that, we are in a very good shape on that side. So as we move forward, so we're going to continue to leverage our core competencies. We want to sustain the existing client relationships, but not just sustain, we want to grow those partnerships and grow new partnerships with new customers as well. Proactive solutions I talked about in the previous slide, and advisory work. Build customer-centered technology solutions. Talk about some of those that are coming up in a second. And continued improvements in terms of our turnaround time and our time to market. Invest in continuous build out and improvements of our technology platforms. Maintain strong risk and compliance culture. Ensure stability of our systems. And also engage and sustain a highly experienced and quality workforce. So that's the core of how we want to leverage going forward. If you look at some of the key channel initiatives that I touched on there, we're not going to solve all of the problems in 1 year. So we are, technology and how we develop is going to be an ongoing challenge, not just for us, but for the industry and for any banking business, I guess, globally, not just in Zimbabwe. But our key strategic aims for this year is to expand our point of sale offering, to develop what we have and improve on it and roll that out, likely to be a Q2 exercise. We're going to relaunch our internet banking platform. Having listened to customers, having looked at the market, we've developed a new platform that again should be released in the next quarter. We want to grow our payroll lending business, which we've launched this year, and we've had a good start, but we see that as a good way forward. And the onboarding of a wider range of money transfer agencies. We've already have a number of partnerships with MTAs, and we're looking to expand that as we go forward. So to protect our balance sheet from inflation, which is a key issue, if you look at the three probably core headwinds we face as a business, it'll be inflation, continuing currency volatility and devaluation, and then there's a macro situation in terms of stability of policy. So we need to rapidly grow our underlying business, building out digital capabilities. And that's number one. Number two, we have to have an increased focus on the foreign currency denominated business. Samuel touched on that in his presentation. And that's supported by both our own deposits, but also third-party lines of credit, whether we've got a clear target to grow that credit, those third-party lines of credit by 30 million this year. We want to increase our investment in physical assets. Samuel touched on it, we did a number of property transactions last year. We purchased some land and a number of properties, and that's something that we will continue to look at, focusing on branch facilities and growth for the business. And again, we have a budget of 10 million for that this year. So they're the core summarized strategic aims going forward. So I'll wrap up with that, and I guess we'll open for questions. But just thank you for attending today. I know it was a bit of a nightmare for a lot of people. Traffic was not very easy. So thank you for making the effort to get here. Thank you for those online. And I'll wrap up there. Thank you. Just waiting for Dizzy to join us. He's going to lead us in song.
Thing to save my life, but we're going to the Q&A session. Maybe we can start now. Is there anybody with some questions? Thank you, and Mr. Kapanji can answer them. Anyone? Thank you, sir.
Thank you. My name is Utanai from MMC Capital. I've got two questions from me. The first one being, I noticed that there was some income that came from the joint venture that you talked about. Maybe you can shed more light on that sort of arrangement. Then the second question from me me relates to the dividends, which I think the market is celebrating now. How sustainable is that? Can we expect those kind of dividends yields going forward?
Thank you.
Thank you. So let me touch on the JV income first. I think it's fairly well known that together with our pension fund, we have a 50-50 share in a hotel in Victoria Falls, mainly the Kingdom Hotel. So that's essentially what that income is. It's our share of that. You can imagine that in the last year that's been a challenging environment for any hotel operator in Victoria Falls. But having been there last week and seeing the optimism there, I think there's a good deal of optimism that we can expect some kind of uplift in Vic Falls in the year. So that's that one. Hopefully that answers your first question. In terms of the dividend, it's a good question. And I was saying to somebody before this meeting, the problem with a good year is the pressure to improve it next year. So if we achieve our growth plans and our trajectory, there's no reason why we can't continue with that type of dividend yield. That would be our expectation, that we can continue with that. As you know, in Zimbabwe, there's many volatile situations that can occur. But based on our plans, there's no reason why we shouldn't be able to maintain that trajectory.
Maybe just to add on it, I think the policy around dividend payments in the bank is also quite judicious. I think we do look at the performance for a period, and we also look at quite a number of factors amongst which would be things like your capital position, your liquidity, and stuff like that. And where all elements take, we find no reason not to make payment for the dividends. But obviously, every declaration will actually be subjected to that kind of rigor in terms of the assessment of an instrument.
Thank you. Do we have more questions?
Thank you. My name is Cornelius from Morgan & Co. So I know this is a pre-election year. There's going to be a lot of exchange rate instability. How are you guys going to capitalize with that trend with regards to your FX income? I know you did mention that the stability affected your FX income last year.
Let me start, and then I'm sure Fanwell will come in. I think the year-on-year, Fanwell alluded to what happened year-on-year, but it was also in 2020, there were a number of one-offs. We did a number of significant LCs that were revalued that gave us one-off gains. They won't recur, so that's part of the reason why the FX income has changed. But we have, as part of our strategic approach, we have, I won't go into the details of it, but we've got strategic aims around FX. We recognize the election year. I think the volatility will continue with the trajectory it is in terms of devaluation. And then we, as a bank, have strategies of how we deal with that. We have got plans for it.
Yeah, sure, thanks. And in terms of management of the positioning, so we generally allow in our FX positions. And if the outlook is that the rates will probably nosedive, then I think that would suggest that we probably would be in the money. And I think one of the things that we also then seeking to do is to actually create even bigger capacity for us to actually convert a significant part of our balance sheet into currency, so to speak. But obviously, we are a local bank. We're exposed to local currency in a very significant way, and there is very little we can actually do to remove that situation on the balance sheet.
Thank you, Fano. Any more questions?
Thank you. My name is Tabonga from Vincent Capital. So I noticed that your lending to the agricultural sector increased from 4% to about 16%. So noting that the rainfall season for this agricultural season was a bit late, and we are probably going to be expecting maybe a less than average buffer harvest than the one that we had last year. Where do you stand in terms of your lending going forward to the agricultural sector, that is?
Thanks for that question. You're right in your observations. In every farmer I've talked to so far, they're incredibly optimistic about what's happened this year. I don't see a cause for concern this year. Yes, the rainfalls haven't been as good as last year, and maybe they came a bit later. But while the crop yield may not be as high, people are expecting better prices. So I think from an income perspective, we're not expecting any issues. I don't see a reason to change our value proposition and the work we started this year with the agriculture industry. I'm very optimistic, and I will continue to look at that as an industry for lending, and we'll continue to do that.
Thank you, Kieran. Just looking across the room and trying to ascertain that there are no more questions. Anyone else? I think we can safely say that Kieran and Fano did a great job of explaining our full year results. So I think that brings us to the end of the official proceedings of our analyst briefing. To our online viewers, thank you for joining us. Please note the recording will be available on our YouTube channel, Twitter, and on LinkedIn. And to everyone who's here, thank you very much. We look forward to the interactions after the session. Thank you for being here.